In 2021, thousands of Canadians took out variable mortgages at 1.5%. 2 years later, some of those same people were paying up to 7%. And not because they made a bad decision, but because they didn't fully understand the risk involved. If you're renewing in 2026 or in the next 12 months, or thinking about buying or selling in 2026, this video could save you tens of thousands of dollars. Today, I'm going to show you exactly what happened, why variable mortgages became dangerous so quickly, and how to choose the right strategy going forward, not based on headlines, but on risk tolerance and real numbers. Guys, I'm Ryan McMillan, a local real estate agent here in Vancouver. Help people buy and sell homes. If you're new to the channel, you've been hanging out watching the channel, you haven't subscribed yet, go down, hit the subscribe button right there. Also, you can book a call in with me. QR code is right on the screen. All my links in the description. Feel free to contact me and we can set up and talk strategy with you. Let's waste no time. Let's get into the video. For decades, Canadians preferred 5-year fixed mortgages. They valued stability. But after the pandemic, affordability became the dominant concern. So what you saw by late 2024 and into 2025, variable mortgages made up nearly 40% of new mortgage financing. That's roughly 1/3 of all outstanding mortgages. So you're asking, why is that? Because variable rates were lower. People weren't being reckless, they were being practical. But variable mortgages come with one major assumption. It's that rates will keep falling. And that assumption is now being tested moving into 2026. So let's look at how variable mortgages really work. Variable mortgages, they're tied to the prime rate. Prime moves with the Bank of Canada's policy rate. So when their rate goes up, variable borrowers feel it immediately. There's no buffer, there's no grace period, and there's no warning. During the pandemic, variable rates fell as low as 1.4 to 1.6%, practically free money. By 2023, many borrowers 2 years later paying 6.5 to 7%. That shift happened faster than almost anybody expected. So what actually happened? Let's look at some real stats here. So between early 2022 and 2023, the Bank of Canada raised rates 10 times, and this wasn't gradual. Variable mortgage rates didn't inch higher, they jumped, and that caught people off guard. So let me show you exactly what that meant in real terms. So let's say you had $1 million mortgage. Look, like here's the real numbers, right? So let's use the $1 million as an example. So a $1 million mortgage amortized over 25 years at 1.6%, that monthly payment was roughly $4,000 per month. Okay, so manageable for many households. Now let's look at what happens here at 7%. So as you see here on the chart, that same mortgage jumps to roughly over $7,000 a month. That's an increase of about $3,000 every single month, 36,000 per year after taxes. And this wasn't hypothetical. People were living through this. And so you wonder, well, how did people get trapped? You know, the bank just doesn't go from 1 to 7. Well, most of these borrowers, they didn't make a mistake. They qualified at these low rates. They passed stress tests, which usually is a couple percent higher. It's not 1.5 to 7. And they expected gradual increases. But variable mortgages adjust immediately. So some borrowers saw payments skyrocket. Others were on fixed payment variable mortgages where the payment stayed the same, but the principal stopped going down. In some cases, it went up. So that's how people were getting stuck. So what does this all mean? We've seen a bit of history here in the last few years. Why does this matter now heading into 2026? Now, I'm not saying we're heading back to 7% tomorrow. That's not the point. The risk isn't about dramatic spikes. The risk is rates staying higher for longer than you expect. So even a 1% increase on a very large mortgage, it makes a big difference. So even on a $900,000 mortgage, a 1% increase can mean $500 to $600 every single month, or $6,000 to $7,000 per year. That's real money. So when we shift over to looking at inflation, what's the data telling us? So inflation's cooled, but it hasn't disappeared. Shelter costs remain high. Service inflation is sticky. And the Bank of Canada, after the last rate announcement in December, they've already signaled it's likely done cutting rates for now. Markets are even pricing in the possibility that the next move will be up and not down. So that's why economists, including Desjardins, are warning that 2026 may be less favorable for variable rate borrowers. So most people ask this. They either ask, should I go fixed or should I go variable? And I think that's the wrong question. The right question is, how much uncertainty can I handle? It's an individual decision. Mortgage decisions should be built around income stability, your family obligations, your time horizon, and how much cash you have on reserve. The cheapest rate today isn't always the safest choice tomorrow. Okay, so let's look at your renewal strategies by your risk profile. There's basically three profiles. You have the low risk borrower. Okay, so if payments certainly matter most, a 3 or 5 year fix often makes sense for you. This protects you from potential rate increases in 2026 and 2027. And then we look at the moderate risk borrower. That's usually a 3 year fix offers some balance for you. Protection now with some flexibility later after the 3 years. And then you have the high risk tolerant borrowers. Variable can still work, but only if you can absorb a 1 to 2% increase. You have strong cash flow and you have liquidity. Variable rewards discipline and punishes optimism. So what does this mean if you're a buyer heading into 2026? So buyers heading into 2026 should focus less on chasing rates and more on your structure. Fixed rates offer certainty, variable introduces volatility. Prepared buyers will do well. So what does this mean for sellers? In a quick summary, for sellers, renewals matter for sellers. So as mortgages reset, some homeowners will face payment pressure, and we've already been seeing that. That doesn't mean a crash, but it does mean people are getting ahead of it. There's more listings, more negotiation, more importance on pricing correctly. People that are being proactive and saying, hey, we need to sell our place because we're not going to be able to handle the price shock. They have to price sharply and with a correct strategy. So you've been seeing this now in the latter half of 2025. Earlier in the year, people were stuck on old pricing, old markets. Later on this year, we've seen that realization where sellers are like, okay, we are in the new market, the new world as things are going forward here. This isn't 2021 or 2022, and we need to sell here. We need to be realistic. We need to price our property sharp, and this is a thing. So the right mortgage isn't about predicting rates. It's about understanding your risk and planning for it. If you're renewing the next couple of months into 2026 in the latter half of 2026, guys, drop a comment in there. Comment renew. I'll help you think through the smartest strategy for your mortgage needs. Now, again, guys, I'm not a mortgage specialist, but being a real estate agent, it goes hand in hand. So as we're thinking about the type of house you want to get into and your next move, we can start talking strategy, and then we can bring you over to the guys on my team as well for all your mortgage needs. But again, guys, appreciate you making it to the end of this video. Don't forget to subscribe to the channel, and I'll see you guys on the next video.